Should work. All right, there we go. Whoa. Are we live? All right, we're live. So apparently we're going live. I thought I was going to go live in a little while, but we're going live now. I hit a button. We're going. So hey, what's up, Cashflow hackers? It's Chris with Life 180. I guess in the post-production, I will clip out the beginning there. But hey, listen, it's exciting to have everybody here. Today's video, we're going to go through index universal life illustrations. One of the things that I have been really big on is helping people understand how to evaluate illustrations. The more I've kind of doubled down on this conversation and tried to focus on educating people how to do it, the more people have reached out, the more people have sent me illustrations of their own, asked me for evaluations. And, so one of the things that I want to do in this video is I have actually an illustration back here, and I'm going to, I'll show you here. That's kind of like a snapshot. I've got an Allianz Pro Plus IUL illustration. 76 pages long that thing is, and I'm going to go through all the illustration. We're going to break it down. We're going to go through and talk about what is reasonable, what's unreasonable, what you can expect, how it will work, where it's going to fail, where it's not going to work. And ultimately, I want you to be able to understand the different pages that you have to look at, and then how you have to kind of cross-reference elements so you can understand where the ultimate risks are. Now, I'm not sure if you're here because you're an agent and you're looking to learn how to do this and how to design and how to evaluate for your clients, or if you are somebody who's looking to buy a policy. Do me a favor, out of the gate, if you're watching this for the first time and you're an agent, give me a 1 in the comments. And if you are somebody who's looking to buy an IUL or somebody that's looking to evaluate your IUL, give me a 2, and we will go from there. And I'll know how to kind of cater my conversation, whether I'm educating agents or whether I'm trying to get, give you information on how to evaluate your own policy as a policy holder, right? And so I think those are obviously different things that we have to look at. So one thing that I want to say right out of the gate here, which is kind of fun for me, is that I have a new thing called the Rescue My IUL Challenge. And we're creating this thing and it's designed to help, how do I say this? To help people that have IUL policies and they're looking for an evaluation and maybe they're looking for a bailout and they're looking to figure out what their options are, whatever. We've got a whole process that we've kind of formalized that's going to help you understand what you need to do, and I want to be able to show it. And so I'm just pulling it up. I apologize. Like I said, I started this stream a little preemptively. I wasn't quite ready. But what I'm going to do here is I'm going to go to this screen. This is the new rescuemyiul.com. And you can see here what we're doing is we're going to basically have anybody that wants to submit their information for an IUL. I have it all set up here. Just give your name, first name, last name, email, and phone number. We just ask that you agree to communicate via text message with us because obviously it allows us to do our job more effectively. If you are doing that, and then what we're going to do is you have the original illustration that you can submit. It's a PDF format of whatever illustration that you have. Now, just so you know, the original illustration, this is not required. It is absolutely suggested. If you have it, please include it because it will give us a lot of value. And then the enforced illustration, the current illustration that you have for your policy, we are going to be able to have that there. That is obviously required because we can't give you any kind of evaluation unless you have it there. But this kind of submission is going to allow us to be able to help you get clarity about what your IUL is like. And so I'm really excited to have formally launched this. We have this out there. It's got the video there that will explain kind of what it's all about. But one of the things that we're doing is over the next 6 months, the person with the worst IUL design, we're going to kind of give them a bailout. So if you were sold an IUL and it's poor and it's not what you thought you got involved with, we will actually give you $1,000 if you are the worst one. Now we have a team that's going to go through and evaluate and kind of look at the person who's put in the worst situation based on their IUL purchase. And the way that you can kind of throw your hat in the ring is by submitting your information. Now, full transparency, I do plan on utilizing this stuff and redacting information, but utilizing these as educational videos. So if you submit an illustration, just know that there's a chance that I'll use it as a review, kind of like the review I'm doing today, for the challenge. And so we'll kind of go from there. Dave, you asked if I can talk about the National Life Group and Premier Financial Alliance. So I can't, oh wow, that video didn't click back over. So on the National Life Group and the PFA thing, I can't speak specifically to those illustrations because I don't have one in front of me right now, but if you have a specific illustration that you'd like to pass my way and you want me to do a formal evaluation of it and do a video like this really evaluating it, I will do so. One of the reasons that I'm really starting to do these live is because I want people to be able to engage and ask questions. And obviously when I do them and I record them, and I've got plenty of like IUL evaluation videos, when I record them, it's just me kind of going through page by page on the illustration. And today what I'm gonna do is I'm gonna bounce around a little bit more and kind of look at it through the lens of the most important elements that you need to consider when you are evaluating an IUL illustration. And when it comes, I will say this about PFA. PFA, I guess before I move on, PFA is no different than WFG or PHP or whatever. They have a, I think the difference is they're probably more like PHP than they are like WFG, simply because of their relationship with National Life Group. They pretty much exclusively represent National Life Group. I know they may sell other companies too, but the overwhelming majority of their business goes through National Life Group, to the point that National Life Group has actually created products specifically for them. But at the end of the day, it's nothing super special. It's basically National Life products with a different name on it. They make a couple little tweaks, but it's still National Life product at the end of the day, right? So, you know, it is what it is. So I would say it's still, you're starting off with that kind of network marketing, MLM mindset. They tell you can build a team. They start you off at very low commission rates. You have to go out and recruit people, all these different things. It's the same as the other companies. It's just their own little spin on the same idea. And so what I want to do now, though, is I want to hop into it. If anybody has any questions, what I will say is if you have any questions, I'm going to do my best to kind of check back and forth, because what I'm going to do is I'm going to share my board. I don't know if you can see it behind me, but I'm going to share this board. I've got an Allianz Pro Plus Advantage illustration. One of the reasons that I'm sharing this, there's two reasons. A, somebody from Alive last week submitted this to me, and I told them I would. And then B, this product is the most popular IUL product sold. It's the #1 sold IUL, I think, in the marketplace right now. It's the IUL product that like people like David McKnight swear by. And a lot of people are saying this is the IUL that has solved all IUL problems, and it's amazing. And so what we're gonna do is we're gonna dive into this, and I'm gonna have some fun. See, I've gone through it really quickly, just to make a couple notes and make a couple points. See, I got a whole slideshow on the side. Each page has its own slide. So before I do anything, I'm gonna pop down to page 70. I wanna focus on the policy inputs so you can kind of see what those are. I wanna talk fundamentally, philosophically about these policy inputs and what it's all about. Now, you can see that we have an option B, increasing death benefit from year 1 through 20, because this person is funding for 20 years. After that, they switch from 21 to maturity. From year 21 to maturity, it switches. So therefore, the idea is when you go option B while you're funding it, it allows you to put more money into the policy. You switch to level A, it makes it so the death benefit doesn't keep increasing along with the cash value. And so therefore, when that happens, it's supposed to hypothetically reduce the net amount at risk. And when it's illustrated, it looks fantastic, I will say that. But the reality is it doesn't really work that way. You can see all the premiums. If you want to pause this and kind of look at it and go through it, it's. I will say, on the scale of things, there are a couple little tweaks that they could have done to make it better. Ultimately, I think the target premium in this was $4,266. They could have done probably made it a little bit more efficient than that. But at the end of the day, with a $12,000 premium, it's not that horrible. So there's a couple things that I want to talk about now, kind of getting into this. Where is it here? I'm going to go to the I've told myself what pages to go to. So policy ledger is page 30. So I want to start on the policy ledger. Okay. Not there. Policy ledger. Like I said, as I'm going through this, if you have any questions, let me know. Hopefully, this will help educate you and you will understand what's happening. So now, what this is not showing is the premium payment. So I think it's important to understand that. So you can see this is the age, this is the policy year. You can see for 20 years they will have funded it. And at year 21, age 60, they are going to start taking income. Now the income that is being taken in this policy is $37,884. So you could see here that this money right there in this column is the income that's taken. But here's the deal. This is where I always say, and what I'm going to show you here is how you have to evaluate the policy loan ledger and then all the other assumption pages that are going to go along with this. And then you're going to have to learn how to kind of cross-reference, do your own math, and create your own assessment on what you think is right. At the end of the day, that's all that matters. Now you can see, remember, when you're taking income in these things, you are taking it through the form of policy loans. So right here, you can see this is your policy loan expenses. These numbers go up and up and up. I think this is really important to understand here. And this is vital if you start looking at this. Even in the first 5 years here, you've taken $189,000 of income, okay? But you have $215,000 at the end of that 5-year period that you owe in loans. Okay, and that just compounds. It gets worse and worse and worse. That's basically almost the equivalent. It's $29,000 in loan credits that you've had, but you have $25,000 in actual loan charges. So what does that mean? That means right here you have $4,000-ish in credits, right? And this is what the illustrated 50 basis points of positive arbitrage leads to, is that $4,000 in positive credits. Now, it's not that simple. Let's take it to the next page. Now, if we look at this, it keeps going down through. By the time you are, let's talk about 75 years old. Let's focus on 75, because I think anybody that buys one of these, you're going to look at this and you're going to say, all right, yeah, I could see why, or I could see how this would be a really positive thing, and I, because it looks really nice on paper, and I think it's pretty likely that I'll be alive at 75. In fact, I think it's between the age of 75 and 85 that matters the most in these policies, because you probably, if things were not going as well as you wanted them to go while you were in your 60s, or early 70s, you could probably keep working if you needed to. You could probably figure other solutions out for your finances if you had to keep working, or come up with other ways to create income. But when you get in your mid 70s to mid 80s, in that range, chances are you're still going to be alive, just mathematically and actuarially. But also chances are that you're slowing down, and that your ability to actually go out and earn income, had you not planned properly, is getting reduced. Now, let's talk about this at 75. You've taken a total of $568,260 in loans. You've had $271,000 of loan charges. You have loan credits of $313,000. But check this out. Your outstanding loan balance is $839,000. This is really, really important, because what I want to go back here, and I want to show this on the previous page, you can see here when we started, we have $433,000 of cash value. We started taking money. You'll notice that you're having more credits than actual loan charges. You're getting more loan credits than loan charges, and yet the cash value is still going down because of the fact that the cost of insurance and other fees inside of the policy are still, working against it. Plus, you also have to look at the fact that you are switched to option A, so your death benefit is reducing, and so the cash value is just going to go down a little bit. And that's not a problem. I have no problem with that, by the way. That from a design perspective, no worries there. That's no problem. Where I do have a challenge is now we start to look at this at the outstanding loan balance, and I think this is important to understand. I want to focus on age 75 right here. You have $839,000 of outstanding loan balance, and you have $280,000 of cash value. Now, that's not your total accumulated value. That's your net cash value. That would be like your surrender value, if you will. Now, this $280,000, it works, and you can see it goes down to 270, 260, 250, 240, 240, and it keeps going down here as the years go on. But the problem is if this is even going down, even in years where we're getting positive credits every single year. But the reality is this, what page is it on? I think it was page 50 I gotta go to, where I wanna show you the index. And I wanna take a little moment, that's right here. I wanna take a little moment to go through this. So here's the deal. I think this is so important for people to understand. When we look at this, we have 1, 2, 3, 4, 5, 6, 7, and 8 years. If we know the loan rate is 5%, which it's going to be, right now it's 5%, it could go as high as 8% on the indexed or participating loans. They call it an alternative loan in some companies. I think it's called a participating loan in this policy. At the end of the day, it's the variable loan that allows you to take advantage of the market participation with the cash that you actually have loaned out. And so when we look at that, we're looking at, these are 8 years out of what, 16, 17 years, 8 out of 17 years that the market performed worse than the cost of borrowing that money, right? So here's what happens. In the illustration that we were just looking at, I always kind of tell people, well, and this is the thing, I always tell people that, first of all, your policy is not going to perform according to this market performance, whatever the index is. Right now, we're looking at the one for the Bloomberg Dynamic Balance 2 ER Index, annual point to point. There's all sorts of different options there. I could look and show you through. Let me see here. I'm gonna go up to an earlier slide and see if I could find. No, that's the PIMCO. I wanted to see. I don't want to spend a lot of time on their marketing pages because I want to stay more technical in this video. So I guess I'm not going to get into that right now. But at the end of the day, what really matters when we're looking at this is that it's important to understand. I'll go back to this. It's important to understand that when we're looking at these policies, that the performance of the policy really has little to do with the index. And the reason I say that the policy has little to do with the success of the index, and I've done a lot of videos on this, so I'm not going to spend a ton of time on it, but it's because the only thing that matters with the success of a policy like this is the general fund performance, which is basically the equivalent of dividend rates, right? Because this creates the options budget. We got to look at, we have to look at interest rates. And we have to look at, which is going to lead to this, and we have to look at options costs. So at the end of the day, this is what I kind of try to tell people, is a lot of people will say, oh, well, we've got this no cap product, or we have this cap product, or we have all these things that are going, all these different options, right? We could have all these different elements. Let me give an example. S&P 500, okay? We could have different options. We could have, let's say you have you have a cap rate, you have a par rate, participation rate. Maybe there's no cap. So let's just say option 1. You have no cap, so there's no cap. It's 100% participation rate, right? But then maybe because there's no cap, and it's 100% participation rate, and that 100% could go up to maybe 165% or something like that. They have a spread charge of 7 to 10% that could go all the way to 15%. Like I just evaluated the New Heights accumulator, nationwide one. They have a spread charge that goes all the way to 15%. Now a lot of people go, oh, Chris, it doesn't matter. Nobody would ever choose the option with this 15% potential spread charge, which by the way, a spread charge is basically saying, right now the spread charge is 7%, and it's saying the first 7% that the market does, you don't get to participate in that. You only get to participate if the market does 12%. You only participate in the back portion, the 5% above the 7% in that. But maybe option 2 is 100% cap rate, meaning if the market does 10%, you keep all 10%. That's the participation rate. I'm sliding my mind here. I'm thinking ahead. The cap rate is 10%, let's just say, and the participation rate is 100%, and then there's no spread charge because it's not viable. Well, in this situation, the life insurance company has the ability to drop this cap rate down, and it has the ability to drop it down to, let's just say 6%. Maybe this could get dropped down to 60% for the participation rate. It is what it is. At the end of the day, it doesn't matter. What really matters is that we have the S&P 500. That's what matters. And so we know whether it's an uncapped index like this, whether it's a capped index here, or whether it's somewhere in between. And I'm not going to take an hour and explain all the different types of indexes that we can have for potential. Actually, I'll go to the index page on this to explain it and break it down more. But I want you to understand this part. It doesn't matter. What matters here is what index you're buying options in, because the cap strategy and what the payout and how they market it and what they show it and how they illustrate doesn't really matter. All that matters is it the S&P 500. The rest of it is just noise and marketing, because at the end of the day, you're still dealing with the same general fund performance if it's from the same company. You still have that same options budget that you're going to have created for that. And all that matters is what are the options cost of the S&P 500. So at the end of the day, if we could have we could have 4 different options of different variables that come into play for how you want to participate in the S&P 500. At the end of the day, they should all come out pretty close to each other. Even the no cap index, what they're going to show you is all this upside. They should all come out pretty close to each other, because of the fact that what happens is your money goes to the general fund. That general fund creates an options budget. That options budget participates in buying call options. And at the end of the day, that's all that matters. So the options budget and the cost of options isn't going to change. These options are not cheaper than the others. You're just dealing with the same variables. The reason that they have to have this ability to control the cap, to control the participation rate and the spread charges and any other variables, is because of the fact that the options budget, the interest rates, and the general fund performance that leads to that will change. And if it goes down, they need to be able to reduce things. Now, if it goes up, they also have to look at the call options and the cost of options that goes in with it. Now, a lot of people have been saying, well, the options budget's been going up. Right now, look at the world around us, right? Like the performance of the market, the general fund, the fixed income market environment has been getting better. So general fund performance has gone from like 4 to maybe 5, 5.5. So the options budget has gone up. And so therefore we should be able to buy more options. But the bottom line is what it's led to is more volatility. So what happens if you understand the options market, volatility equals more cost. The fact that options are a supply-demand product, and the fact that IUL companies have kind of created their own problem, that is what it is as well. And so the cost of options has gone up. So even though your options budget has gotten better, you have not been able to buy more options because the cost of those options has gone up along with it. Does that make sense? So what I want to do is I'm going to go back through here. I'm going to try to find the indexed options strategy. I think it's in here somewhere. I got to find it. It's like kind of blurry. I'm going to try to find the page that looks like it could be. Is that it? Is that it? Is that it? Yep, this is it. So, all right, when we're looking at this, take a look. Let's take a peek. These guys have all these different options, and this is what I'm talking about, right? Just to kind of give you an idea. So what happens is this index allocation, right? Well, you see, let's see here. The Bloomberg US Dynamic right here, point to point. Bloomberg Dynamic, this is the same one. Bloomberg Dynamic, same one. They all have different elements and different things right here that they're managing. These are just different ways to choose to participate in that same index. Conversely, let me go down here. I'll put this on a highlighter, and I'll go red, and I'll try to color code it. And let's go the PIMCO, okay? PIMCO, PIMCO, PIMCO. These are all the same index, but you can see they have different ways to participate in them, and they have different returns, right? So like PIMCO right here, 184% participation rate versus 145 versus 160, right? Now in here, you can see the 10-year average is 10.68 versus 8.46 versus 9.32. At the end of the day, what they're doing is they're adding, this is just, do they want to have multiplier bonuses and at no additional charge? Do you want to have all these other bonuses that come into play? Nothing in life is free. Anytime you do any of these things, you're injecting extra risk into a policy that's supposed to be safe. And at the end of the day, what really matters is what I was talking about before. With this PIMCO fund, you're still dealing with the options budget and then options cost. Guess what? That's the same across for all of these. They're all the same. Doesn't really matter. And so the fact that they can make it look better or look worse or whatever, in some iterations with some variables and some bonuses and some multipliers, this is the reason that regulation AG 49B is coming out and they're messing with all this. If your surrender value looks good, what would you ask the agent about how much fees they can charge? Or is it just 0.75 internal return? Well, so I don't know what you mean if the surrender value looks good. Like when does the surrender value look good? So what I'm gonna do now though, is I'm gonna get into this. Maybe this will answer your question. I gotta get down here. So I'm gonna go through this. So I'm gonna go back to the ledger and we're gonna continue to go through this and flow through this because now, just to kind of reiterate what we were talking about, you can see here that we had, and I'll shut that down so I have more space. You could see here that we have, just to reiterate, I'm gonna bust out the red here for a second. We have a total of $568,000 in loans, $271,000 in loan charges. But think about this, we've only taken $271,000 of loan charges annually. Those charges have added up to a total compounding of outstanding loan balance of $839,000. That loan expense is compounding against you. If you go take a wash loan, it's actually gonna have just as negative an impact on your policy during retirement because you're not gonna be able to eat into the net amount at risk and the cost of insurance is gonna add up. And I'm gonna show all that as I go through here. Now is when we're gonna get into the meat and potatoes of this thing. And I think it's gonna start to make a lot of sense. So, if anybody has any questions about this specifically, let me know. So as we go through here, you can see we have that $839,000 of outstanding loan balance. Even though we've been getting more loan credits than loan charges, it doesn't matter. Those loans still exist and it adds up and it becomes really, really just catastrophic. So here we go. You can see this is just as we get older, the cash value is going down and then it starts going back up when we hit a certain age, but that's just because of the way it all works. But it's just all these numbers are just amplified. And I'll reference back to this part after, and it goes to maturity at 100. Now what we're gonna look at is the policy credits. This includes the premium payments. It includes It includes kind of more of an overview of what's happening. Here's the interest loan credits again. So it's not going to show anything anything negative, because what's going to happen is this is the net of everything, right? So the loan credits are like how much you're earning in the policy. You know, it's growing versus like down here you could see you're paying you're taking $37,000 in policy loans, but it's showing that the policy is still growing because of the fact that you have all this money compounding. And you know, it's possible that would happen, but it's not necessarily likely that would happen, right? Policy charges, and then the accumulated value versus the cash value. Now this is important. This is the surrender value. If you had to cancel your policy, this is how much you would keep. This is ultimately what you have access to from a cash value perspective if you're a real estate investor or whatever. This is not ideal, right? The fact that you've contributed $12,000 and you only have $2,600 net access of that money. And you could see that from that point forward, it starts to get, better. But at the end of the day, you can see that the death benefit is going to increase as the cash value increases. You got 209 death benefit to start, but you can see by year 20 down here, even though you've got 433, you've got about 632. So the death benefit has increased as the cash value has increased. So what the difference is, the spread between the cash value and the death benefit is what we call the net amount at risk. This is what the cost of the COI is based on, which when you're, 41 to 60 isn't the end of the world. But now what happens is we start taking loans for income, and the combination of the loans and the risk on the COI, based on the fact that the net amount at risk is going up, even though this is switched to an option A, which is supposed to reduce the net amount at risk, right? That's what the goal of going option A is all about. Even though they've done that, at the end of the day, you'll find that this is actually a ticking time bomb if you plan on using this for income. So you could see, once again, I'm just reiterating this. They're showing it in a different way, but that's the income that you're taking out. We're going to go to the next page, and we're going to dive down into this age of 75, where you can see total premium outlay, total income, the same numbers as we focused on before. But here's what I want to show you. You have an accumulated value of $1,119,000. You have cash value of $280,000, a death benefit of $358,000. Now this is actually good compared to most policies, because you could see that the net amount at risk is, let's just call it 80,000. It's like 78,000, but I'm just going to keep numbers around. Net amount at risk is 80K. You could see down here, the net amount at risk goes to like 76K. So it remains about the same, but the difference is, even though this remains the same, the COI is going up every single year because you're getting older. So your mortality charges are going to get more and more expensive. I'll show that on a report as we go through this. Here's what I think is really important to look at when you look at this. This number, I'm taking, let's just use, because I've given the numbers at 75, let's focus on 76 right now. Let's say that 76, you want this $37,000 of income, right? Now you are paying interest charges on this, but you're also earning more credits, as I showed on the previous page. It doesn't show this right here, but you're actually, the loan charges are 43. It's showing that it's positive by 73 right there because of just all the growth in the assumed 50 basis points of positive arbitrage. That's kind of what it's doing there. Now, what we have here is an accumulated value of $1,191,000, which is what you're earning credits on, right? So you're earning technically on this, which when you're basing 50 basis points of positive arbitrage and you're able to earn on 1.191 million, effectively 1.2 million, and you're only your total loan exposure at that point in time is, what was it, 75? I'm going to go back to the loan column here. I'm going to go back to that because I want to have the right numbers. I don't want to guess. When you go back to 75, the total outstanding loan balance is 800. Oh, is 839,000. Okay, 839. So we know it's 839. So now I'm going to go back to the other one. So what's happening is we know that we're earning, and this is what you need to look at, and that's what most people don't know how to evaluate. We are earning credits, and so it looks really good on 1,200,000. I'm just going to round up for the sake of being, but we're only earning or we're paying interest on 840. Our loan balance is 840,000. So the spread of these things is like 360,000, right? So this is basically saying you're earning more, 50 basis points extra on all of it, and so it's gonna end up being a really positive number, because when you show positive illustrations every single year, when you show positive illustrations, positive arbitrage every single year, these things do nothing but grow and look awesome. But I showed you at the beginning that about 50% of the time, almost maybe 40% of the time, the cost of money is going to be more expensive, or the performance of the policy is going to be worse than the cost of money, I guess is the easier way to say that. And so what this is showing is just a pipe dream. And let's just say, hypothetically, let's just say, and this will never happen, by the way, I would bet my life on it, that this policy performs exactly as expected up until age 75. And then finally, age 76, you have, it was 839 at that age. Let me go back a little bit. I'm going to go back to it and check it out. I think this is the one. At age, nope, this is the one before it. At age 76, you have a total outstanding loan balance of 920,000, okay? So now we're gonna bounce back ahead. We're gonna come here, I think it's this one, $920,000 of loan charges, of loan expenses, loan liability in the policy. And now what we have is 271K of cash value. Here's what happens. If we're paying 5% on this, right? And then we take our 37,000, I'm just gonna say 40,000. We're at 960K, just to keep numbers really, really simple, really, really round for what we're talking about. And if we have 960K total and we have to pay 5% on that at the end of the year, well, if the market does a 0 or anything less than 5%, instead of earning more loan credits like it's showing on the illustration, having positive every single year, we actually have an expense. So let's assume that we have one negative year, okay? One negative year. Now all of a sudden we have 960K. I'm gonna do the math here. I wanna get the number exactly right just to kind of show you, because this is eye-opening. 960,000 times, it's $48,000 of loan expenses, okay? So you have 48K of loan expenses, but guess what? When you have positive arbitrage, they're just showing, well, you have a loan charge, but you have right here, I mean, I'll show you, like right here, you have 43,000 of loan charges, right? Okay, so I guess I didn't need to do all the math. You have 43K of loan charges, because I guess I rounded up, it's a little less, whatever. 43K of loan charges, and what they're doing is they're assuming that your loan credits are going to be more. So we have 271K of cash value. I think it might be easier for me to go back and use this page as an example, okay? So if we go here, we had 270K of cash value. We had 43,000 loan charges, which I think will be shown right here. I'm going to erase this so I can kind of write this over again, okay? So we have 43,000 in loan charges. What this is showing is $49,000 in loan credits, and that makes up for it. Well, this is assuming that it's a positive year, that that you have positive arbitrage. You're earning more than your cost of loans. Well, if you don't have this, if you have a negative year, if your policy performs worse and this is horrible, and what happens is this doesn't exist. You get no loan credits. This has to be paid. Where does it get paid for? It gets paid from the cash value. That's where it gets paid from. So now you have this, and you minus 43K plus 37K. I'm just gonna make it round, 0, 1, we got 580K total. So now you go 271K minus 80K equals 191K. Now all of a sudden, your policy value, instead of having the next year 262K, you only have 191K. You effectively lost that money, lost that liquidity because you didn't have the positive credits to make up for it. And so when everybody's saying that you have the ability, like these things will work into perpetuity, I always kind of tell people, it's not when you're accumulating money that matters, it's when you're trying to utilize these. And if people are looking at this for long-term care, you're looking at for tax-free income, and you're looking at it from a living benefits perspective, this policy is only good, and these benefits are only as good as this policy being enforced, as you being able to manage it. Now, here's the deal. All those benefits get destroyed if your cash value and your policy lapses, right? Think about that. To me, that's an atrocity. And this is why I'm so passionate about educating people about how dangerous these things are, because at the end of the day, if you have, I'm showing that this thing does exactly what was illustrated every single year, even though I showed you earlier that 50% of the time it's going to perform worse than expected or worse than the cost of money. It's going to add in more costs. So let's assume that it does it the next year. You're going to have more loan costs, more expenses because these charges would have rolled over and been even bigger. So I'm going to erase these so I can kind of start and look and have a little clean slate to look at age 77. But the expenses would be higher than these because the costs would have compounded. The net amount at risk would have gone up because now what's going to happen, you got 191K. So let's go over to the next policy, because remember, the net amount at risk is the cash value minus the death benefit minus the cash value is the net amount at risk. Okay, so I want to go to this policy right here in this age. And remember, I showed you the net amount at risk. I'm going to erase this so I can once again just be clean and just kind of do it again and just explain very, very cleanly. The net amount at risk at 76 on this one is 273. It's like 60K. It's this minus this. And then here it's 326 minus 6. So it's about 60K there too, right? But now what's happened, because we reduced it, instead of 262, we have 191. And so now 326 minus 191 is 5, 2, 12, 3, 1, 135. So now what happened is from 60K, you went up to 135K of net amount at risk. That increases your cost of insurance hugely. So the costs are going to compound against you, but guess what? It doesn't show that to you on the illustration, right? To me, that is where these things kind of completely fall apart. And so now when we go back to this cost and we start looking at it, if we have only one more negative year in a row, now we have 191,000. We have a higher cost of insurance. These costs are actually, the loan charges are going to be higher. The cost of insurance are going to be higher. Everything's going to be higher. You have 2 or 3 bad years out of 5, 6 years in this thing in retirement when you're leaning on it, then guess what? All of your long-term care benefits that are attached to the success of this policy, all of your tax-free income that you were leaning on for this policy, all of your living benefits that you were relying on for this policy go away with your cash value. Not only that, because they have overloan protection riders, which are great, but if all this happens because you started taking income, I'm waiting until after 75. But if it happens above this green line before you're 75, the overloan protection riders do not protect you. And what the overloan protection rider is saying, if you lapse this policy, we're going to protect it from, we're not going to allow the loans to lapse the policy to the point where it will destroy the policy and create a taxable consequence for you. But after 75, if it lapses, you can experience a taxable event. And a taxable event on this will include all of your loans. You will have to pay taxes. And in this situation, if we look at this, a taxable event, outstanding loan balance, if it happens at 80 years old, you're looking at a 1.4 million-ish taxable event where you're gonna have to pay taxes on $1.4 million. Like, so that's that. So, all right, I'm gonna try to catch up. Read some of these comments. Tell me, guys, give me a 1 if you think this is helpful, please. Like at this point in time, like I'd love to see, actually give me a 3 if you think it's helpful. I apologize. Like if this is giving you clarity and helping you understand this stuff a little deeper, because this is complicated, right? Like these products are sold as like a very simplistic product, but at the end of the day, they're a much more risky product than anybody, even most of the agents, and they're even aware, right? That's why I'm so passionate. I'm hoping that I can open IUL agents' eyes up to see, and understand this to a level that they understand there's different solutions out there that they can provide what they're actually selling. That's one of the reasons I started selling whole life insurance, because I sold IUL and I loved this and I believed in it. And then when I learned kind of what I'm teaching you, and I realized like, man, I'm not interested in having to apologize to my clients and to put my clients into worse positions. What I really thought I was giving them is actually what I'm giving them now with whole life insurance. And that's why I kind of pivoted and started doing whole life insurance as powerfully and passionately as I am now. And so that's why I do it. So let me read a couple of these comments. So it's good for taking out a loan and death benefit, but not good for investment or retirement. No, I would say it's not good for a loan, because when you look at the risks that the loan inject to everything, as soon as you take loans against IUL, the risks compound against you. And I would say this, with whole life insurance, the same risks exist to a certain extent. The difference with whole life is it's a much more controlled environment, and that the swings cannot be as high, and that the cost of insurance are fixed, versus when you have a loan go bad with an IUL, not only does it cause a problem, with the policy, it causes a problem with the cost of insurance, it causes a problem with the cash value, and those costs will compound. And if the loan isn't met, and this is the same with whole life, by the way, so it can be just as bad if you don't manage it. It's just easier to manage. And if the whole life policy is mature, you're likely not going to run into that issue. And if you work with somebody that that understands this stuff, you can actually guarantee yourself to not have that issue because the cost of insurance are fixed. With Index Universal Life, the challenge is you have annual renewable term. And I see somebody asked the comment, Hank Poncelet asked, with an IUL, do you have to pay for term life insurance every year for the life of the policy? My guess is that would negate all the profits when the policy owner gets old. So yes, Hank, the answer is yeah, you absolutely do. And actually, that's a great point that I kind of omitted. I kind of skirted past. Let me get here. I think this is the Let me find the right policy ledger, cost of insurance. So this is the one thing. So everybody that says IUL is cheaper than whole life insurance, buckle up. This is going to be fun. So remember, this policy started with about 200K of death benefit, right? Think about that, 200K death benefit. Now, simplistically, you see the cost of insurance, pretty cheap over periods of time, but they have rider charges. Now, there's no charges for riders right here. Total policy charges during that period of time from the age of 41 to 65 is $42,000. Now, 4, 8, 12, 16, 20, that's about 20% of the total death benefit that you are paying in total fees. That's going to be pretty comparable to what whole life insurance is during that period of time. This is the difference. With whole life insurance, you can always pay up the policy, and at 65, I could say, hey, I want that policy completely paid up. I don't want any more expenses. I don't want any more charges. And that is what it is. So you'd have no more cost of insurance at the age of 65 if that's what I choose. Some companies with whole life choose 75, some choose 65. But let's just say 65 for the sake of argument. And I guess fairness, some whole life companies stretch it out to 95, 99. Some do full pays to 120. But with IUL, you are going to have these charges through the form of annual renewable term, which that annual renewable term, once again to reiterate, is based on your net amount at risk, which always, it's it's just there. Like that net amount at risk is compounded and grows as soon as you start taking loans against it. That's what injects more risk. I'm sorry, I got a little sidetracked because I started reading a comment while I was kind of doing this. So here's the deal. When we look at this, the total policy charges, by the time you're 90, you got 123,000. Now this policy is actually designed really well for one of these Allianz products, but you're still talking about $123,000 of policy charges for $200K of death benefit. I promise you that is more expensive than whole life insurance. And the reason is when you start looking at the cost of insurance here based on the net amount at risk, but remember, what is this based on? When we start talking about these numbers and the cost of insurance, what was this based on? This was based on, if you remember back, it was based on 60K of net amount at risk, okay? What did I show? I showed 1 year at 67, that 60K, instead of having 60K net amount at risk, it went to 130K, right? So this number would effectively double. All these costs of insurance would double. All these numbers would double. And it creates all this compounding negative effect inside of the policy. And I'm telling you right now, understanding the fact that you can never pay up the insurance and that you're always exposed. And as soon as you start taking income against an IUL, what happens is, you're just exposing yourself to all these risks that you probably, most policyholders are not aware that they even signed up for. They bought this policy because they were sold on this 401k alternative, tax-free income in retirement, this upside potential, downside protection because of market participation. And basically what I've shown you in this video is how to evaluate an IUL, how to look at all the different moving parts and all the variables and what to consider. So, and how to kind of like compare all the different parts of the illustration to make a better decision for you. When I look at this illustration, it looks really good on paper. Somebody feels like they could fund it at like $12,000 a year, and then for 20 years, and then take $37,000, almost $38,000 tax-free income for the rest of their life, starting at 60. It's just not reasonable, and it's just like. The crazy part is, I bet you this illustration illustrates at a better rate of return than the equivalent indexed annuity that Allianz has. And it's only because that 50 basis points of positive arbitrage that are illustrated every single year, even though we know with 100% certainty that that's not going to work that way. That is the problem with IUL illustrations, and a lot of people always give me flack, like, Chris, you like whole life illustrations, and you talk about whole life illustrations, they have the same problem as IUL. The answer is no, they don't. And the answer is also, I'm not a big fan of selling off illustrations, but I can look at the non-guaranteed portion of a whole life policy and be very confident with it at this point in time because of the fact that even on a non-guaranteed part of a whole life illustration, the only thing that's non-guaranteed is the dividend. And if a company's paid a dividend for 120 plus years, and if the dividend rates are at all-time lows, I could still look at that non-guaranteed section and have a lot of confidence that it's still going to outperform that in today's market environment. 30 years ago, that whole life policy definitely would have kept performing worse and worse and worse because the dividend was going to go down. So as the dividend went down, the policy performance reduced. That's how it works. But with these that are sold with upside potential, downside protection, and then that not taking advantage of the potential and the actual upside of the marketplace, that's why I created the IUL challenge. Now, if you are a client, I started off the video, but I know I got more people on at this point in time that are doing this. I am launching this new thing for Life 180 here called the Rescue My IUL. It's rescuemyiul.com. You can go check it out. I'll put the link in the description below if you're watching the replay, or just go to rescuemyiul.com. You can see the domain there. And this is what I'm doing. I'm looking to pay $1,000 over the next 6 months to somebody who has the worst policy out of the group that's been most negatively impacted by this. But I'm really looking to build a case study and to be able to help people, because the goal is to say, hey, if you have an IUL, get an evaluation. You can submit your original illustration if you have it so we can evaluate it. And then the current illustration that you have, get the in-force illustration of the current status of the policy, and we will help you evaluate where you are with your policy, what your best options are, and kind of go from there. Because at the end of the day, too many people are being sold these policies without really understanding what they're getting involved with. I will say this, because of the fact that what I showed you based on surrender charges and so on and so forth, if you don't have loans out, if you don't have anything of that nature going on early in the policy, a lot of times it just makes sense to kind of ride it out, get through the surrender period, and then 1035 exchange once the surrender period is gone. And sometimes it's so atrocious that just getting out of it quickly will make sense. I will say there's some sales tactics out there like MPI. MPI uses a lot of policy loans really early in the policy. And so those policies, in my opinion, are extremely dangerous because of what I explained on this. It's not about MPI. It's not about his relock strategy. It's not about any of that. Whatever. It's marketing. It's a terminology. It is what it is. At the end of the day, all it is an index universal life policy, and you can't change the moving parts of how the index universal life works. How it works is exactly like I showed you with the policy loans injecting more risk. The difference when you start taking policy loans early in the policy is you're injecting more risk early in the policy. And the worst part about that is that if your policy lapses before you're 75, you will have a taxable consequence, right? And it's going to be ugly. And I'm telling you, I think a lot of people that do any kind of policy where you're taking early policy loans for any reason and you're not managing the interest and you're not paying for that interest. And it's why I'm a big believer in real estate investing, because we use the cash flow from the real estate with whole life to manage the interest expense in the whole life policy, all the while we're not interrupting that compounding, right? So we're managing and controlling the variables inside of the policy. I'm not going to sit here and tell anybody that you don't have to take risk to be successful and to get to where you want to go in life. I take a ton of risk in my life, right? I do, and I love it, and I wouldn't change a thing. I don't want to take my risk inside of my whole life policy, right? That's it. Life insurance companies are not great at getting massive returns. If they were, they'd be doing it for themselves. They do one thing and one thing better than any other financial institution set in the world, is that they manage risk and they'll get you the best possible return with the least amount of risk possible. That is what they do, hands down, no questions asked. And from that perspective, that's why I want to keep my safe, liquid, accessible capital inside of a whole life policy, not a bank, because I'm going to get other benefits with it. But I cannot look at a whole life policy as an investment. That is a big thing. So Lulda asked if I can consider to post a couple of days ahead before we go live next time. Tell you what, if I can schedule something ahead of time, I will. A lot of times these lives, I just kind of wing it and I'm off the cuff. If you haven't already, you can go to life180.com and you can subscribe to our list. And what I do is I do email our list before I go live that day. That way everybody's notified that we're doing it and they can engage with it. I will try to absolutely post and let people know that I am going to go live. I can't promise I'm going to be successful in doing it, because like this live, honestly, I wasn't even going to go live until like 15 minutes before I went live. And even then I was going to wait a little bit. I accidentally hit a button and went live 10 minutes early. So I was totally unprepared when I started this thing, but hopefully it turned out well. I actually got a roll. It's my 5-year-old daughter's birthday today. She turns 5 today. My baby is growing up, and so I got to go pick her up and get ready for her birthday. So it's going to be a really exciting night around this house. But I'm glad, hopefully you guys found value in this. If you did, I would really just be honored and appreciate, like, if you have anybody that needs to learn about IUL or wants to learn about life insurance in general, agent, individuals, anything of that nature, share this video with them. Bring people. I think I'm doing my best. I'm doing my best to like provide the best value and the best content for training around this stuff on the internet. A lot of times people that are trying to train for this kind of IUL stuff are charging a fair amount of money to do it. And I'm just trying to bring it for free, because I just believe I have a responsibility to get this information out there to people. So would the live podcast saved in this channel? Yeah, so what I do live, anytime I do a live, you can always watch a replay on the channel. In fact, when I do a live, I might, like right now, I can tell you, I'm looking at the analytics. I've had 67 people watch this, at least to some extent, while I've been on here, for an average view time of almost 10 minutes per person. Been going live for 50 minutes, 60 minutes almost. So that said, the last lives that I've been doing have been about the same, but we've had, hundreds and hundreds and hundreds of views of the replays each time. So I would say Yeah, the replays are always watchable. I think sometimes they're better because you get to watch them at your own pace. You get to rewind, you get to pause it a little more effectively. And so sometimes that's good. So absolutely, if you miss the live, come and watch a replay. It'll always be on the channel. I always keep everything live and try to keep everything accessible for everybody all the time. So that's it. All right, I'm gonna roll. Thanks for being here. Hope you guys enjoyed. Hope you found benefit in it. And that's it. Have a blessed, inspirational day. We'll talk soon. See ya.